So the latest numbers are in from Nationwide, and UK house prices now sit at £260,828 on average, which is minus 3.8% down from July of 2022. Now, according to their analysis, this is the fastest rate of house prices falling since the global financial crash in 2009. However, if we look back at how much prices have come down so far since the peak in August 2022, we're only down 4.5%. Back then, they had house prices on average at £273,751. So what's next? Is this going to continue, or are we going to get some kind of soft landing? Are the doom and gloom headlines onto something, or are they exaggerating things to get those all-important clicks? Well, as usual, let's have a quick look at both sides of this argument, see what people are saying, and then I'll add my own take at the end, and don't forget to add your own take in the comments too. Back to this report then. Nationwide's data has just been released, and you might have seen the headlines that some of the media have chosen to run with. Some of them definitely like to make it seem like the housing market is falling apart, but that's not what the report actually says. So, although house prices have dropped, it's not like they've suddenly become a bargain and everyone's desperate trying to sell. Looking at the market in general, they say there were 86,000 completed housing transactions in June, 15% below the levels prevailing the same time last year and around 10% below pre-pandemic levels. And then they go on to conclude that, while activity is likely to remain subdued in the near term, healthy rates of nominal income growth together with modestly lower house prices should help to improve housing affordability over time, especially if mortgage rates moderate once bank rate peaks. So in short, we're probably going to be in a slump for a bit, but wages have been going up and inflation's been getting a little better, and we'll probably see rates come down a bit from those scary headlines that we've all been seeing. Now, if you dive a bit deeper past the surface level stuff and grab their raw data, you can see how hard it is to make general statements about the housing market, as it's really lots of areas of the country all jammed together. So although the average drop might be 3.8% down, have a look at the regions and they tell us a slightly different story. For the latest quarter that we're looking at now, you'll see different things here depending on where you look. So, for example, almost all of the largest falls year over year are concentrated in the south. Now, East Anglia is down 4.7%, London's down 4.3%, and the southwest is down 4%. All of those areas also had very high prices to begin with, so just bear that in mind when you look at averages, as this can really skew things. Now, other areas aren't all that bad. The northwest is the odd one out with 4.1% down, but other areas are not seeing such big declines. The East Midlands fell by only 1.1%, Wales and Scotland both are under 2%, and Northern Ireland actually saw an increase in prices by 0.7%, so completely bucking that trend. What is clear though in the report is that we are definitely seeing a slowdown in activity. They add that activity is still around 20% below that of 2019 levels before all of the pandemic. Now, the big question then is, with 20% less activity, is this going to translate into a 20% drop in prices so we can actually call this thing a crash? Well, I'm not so sure yet, but we all know what the elephant in the room is and we have to talk about them. Interest rates. In my last video on the housing market, I covered the so-called upcoming mortgage time bomb, which is about all of the current mortgages up for renewal over the next 18 months, which in total comes to 1.6 million deals between now and the end of 2024. Almost all of those current deals, of which I'm sure many of you are on right now, will be somewhere below 2% interest, meaning that your mortgage costs are only really going in one direction, up. Right now, the base rate set by the Bank of England is 5%, with it widely expected to rise by at least another 25 basis points in the next few days, taking it to 5.25%. After that, the markets are currently predicting that the rate will have to go up to around 5.8% by March 2024. Meaning that mortgage holders are in for a wild ride when it comes to getting new deals, and first-time buyers are heading for a pretty tough time. Just bear in mind though that these forecasts and projections change all the time. I'll pop up on screen now how expectations of these rates has a major effect on the mortgage market. Now, as you can see, back in May, the expectations were that rates would peak under 5% and slowly go down from there. Whereas in early July, once we had that rubbish inflation data, these markets were expecting around 6.5% to be the peak. Now, at the end of July, this blue line is currently where things stand, and thankfully, they're a bit lower because if you remember, we had the latest inflation data come up a little better than expected, even if it was still way too high. As many of you will know, this directly affects the mortgage market and the rates on offer. Checking now, let me show you some of the best offers around. First up, I've said I'm looking to remortgage a £240,000 house with £160,000 left to pay, giving me a healthy loan-to-value ratio of 67%. And as you can see, I get offers with very close to 5% with monthly payments between £929 and £948. For perspective, if your old rate was 1.75%, that's an increase in monthly payments of almost £300. And then, as a second example, let's say you're a first-time buyer and looking to get the average house with a 10% deposit of £24,000. Here's what the best deals say you can get right now. Rates are all over 5% with monthly repayments at just under £1,300 per month. Again, just for some perspective, those same first-time buyers with rates of around 1.75% would have had payments of £890. So almost £400 more a month is now what they'd have to pay. And this is the key part, isn't it? Where does it break, and at what point are there just not enough buyers in the market, or maybe even a flood of sellers who can't suddenly afford a jump in mortgage costs when we're all being hit with a cost of living crisis? Let's just lean into that then. We've got millions of mortgages coming up for renewal, high interest rates and living costs are mounting up, and we know that pay growth for most people isn't keeping up with inflation, another topic I actually covered on the channel. There is definitely a worst case scenario where interest rates stay high, inflation can't get brought down unless we get into some kind of recession, and many people lose their homes or maybe go into negative equity. Now that's when the value of your house is lower than your mortgage, so you end up owing the bank more. Now, let's not forget that a bank doesn't want to have to bother repossessing your home. It costs them a lot of money, it's time consuming, and they might end up having to sell the property at a big loss. Lenders much prefer you to stay in it and provide them with that nice monthly income. But it could happen. However, of the people that can't manage, I think we're more likely to see a few other things happen. Remember last month when the Chancellor Jeremy Hunt was meeting with some of the major banks, he set out a few key measures that they agreed, and I think we'll see more of these moving forward. Of the most important ones, they agreed that homeowners could extend their mortgage and also move on to interest-only deals to protect themselves from high interest rates without affecting their credit scores. And then also there was a measure suggested that there would also be a 12-month minimum period that a bank could even go into repossession, buying more time for those people who might have to go through the worst. I don't think we can see the data on any of this, like how many people are moving to interest only or how many people are moving their mortgages to much longer time periods. But there is a bit of data on mortgage arrears and repossessions. So according to UK Finance, they reckon that 750 homeowners and 410 buy-to-let properties were repossessed in the first quarter of this year. And that is up 50% compared to the same quarter of last year for homeowners. And for the year, that's a 25% increase. Now, is that high or something to worry about? Well, going up is never going to be a good sign. However, you do need to put this into perspective and go back to the last housing market crash to really get a good view if this is big or not. So for example, these are quarterly numbers, so that's 3 months worth. But if we go back to the worst years of the past, these really are small in comparison. For example, looking back at those repossessions, 2008 saw 40,000, 2009 saw 48,900, and then between 2010 and 2012, we saw between 33,900 and 38,500. This is the equivalent of around 8 to 10,000 a quarter, nowhere near where we are right now, but then sure, we've not yet seen the effects of the mortgage crisis filter through, so who knows? I just thought it was worth trying to put things into perspective to try and figure out where we are right now. Looking back, where did house prices go during the global financial crash? Well, if we go back to our nationwide data, we had an average peak house price of £183,000 at the end of 2007. And then this fell to around £160,000 by the end of 2009. And with some quick maths, I make that a dip of around 15%. Now, lots of areas would have seen prices fall a lot more, but that's the average at least, and a good reminder of what's possible. But then, of course, interest rates went to the floor after the crisis pretty quickly, so this isn't really the same issue we're facing now exactly, but still worth looking at. On the flip side, let's just put the positive cap on and see why there won't be a crash. Well, firstly, like I said, banks really don't want to repossess if they can avoid it, so I do think we could see a lot more people extending their mortgage, get payment holidays, or even take interest only for a potentially longer amount of time. At the end of the day, lenders get more in the long run, so it's good for them. Secondly, I do think that inflation will come down, which then should lead to either a stop in interest rate rises by the Bank of England, or at least a cooling so we stay flat for a while. And then also, let's not forget, the job market is still really tight, and we still have the age-old problem that there just aren't enough houses to go around, and the supply is generally too low. And while there are loads of people who have very little, there is a big enough group of people out there who do have cash, or at least can get help from the bank of mum and dad, who are sitting on generational wealth in their own properties and pensions. The bank of mum and dad is a huge lender, don't forget that. And in some markets, some people will be happy to pay up as it really just depends on your local area. Also, one more thing to note is that this topic is such a hot potato that politically, you can't let it crash and burn to the ground. We already saw Jeremy Hunt speak with the banks, and if things start to look worse, you can almost be certain that some kind of interventions get made, especially as we head into a general election year. Just like we saw with the energy price cap, I honestly think that the government steps in if it gets really bad, because this is a sure way to lose votes, but I'd really love your take on this one. Would they really let a market crash happen if you believe that's coming? Let me know in the comments below. So look then, prices are falling a bit, we don't know what's going to happen in the future, there's a huge amount of uncertainty, but we do know that current rates for mortgages and new buyers will put a huge amount of stress on already tight family budgets. The next 12 to 18 months I think are going to really be a turning point, and I think this all hinges on inflation. If this can come down to an even sensible number, then rates could get held or even lowered, as I think there might come a point where there's no choice. But as always with these things, it really does depend on your own situation, where you live now and what your mortgage is like now. A house price crash of 20% or more? Maybe in some areas, but this is the UK, remember. People love owning property, it's a national religion. Anyway, please continue the conversation below. There's loads I haven't covered. I don't claim to be an expert, it's just an interesting talking point to start. And on that point, I did a video recently asking the question if you should save, invest, or pay off your mortgage that you might also be interested in. Watch that one next, and until next time, happy investing.